All right, curious minds, welcome back to the deep dive. We're here to slice through the dense stuff and, hand you those invaluable nuggets of knowledge. Today, we're pulling back the curtain on a world that often feels like it's just about crunching numbers, but trust me, it's more like a high stakes detective story. The world of financial audits. Our mission today, well, it's to demystify how auditors go from like a huge stack of company documents to a really robust, informed opinion on a company's financial well being. Think of it as a deep dive into how they figure out the true financial pulse of an organization. We'll explore how these financial detectives dig deep into a company's environment, how they size up its internal safeguards, what makes audit evidence truly reliable, and how cutting edge tools like data analytics are completely changing the game. Get ready for some serious aha moments that hopefully will shift how you view financial reports. Okay, let's start at the very beginning. Before an auditor can even think about checking a single number, they have to basically become experts on the company itself. It's sort of like a doctor getting to know a patient's entire medical history and lifestyle, right?
Yeah.
Before prescribing anything. Why is this initial deep dive so crucial?
Oh, it's absolutely foundational. The purpose of this initial risk assessment isn't just about eventually finding misstatements, though that's part of it. It's really about setting the stage for the entire audit. It lets auditors make informed judgments about everything, from what level of misstatement would actually matter, what we call materiality, to designing effective procedures and, ultimately evaluating all the evidence they gather. Without this understanding, the audit just wouldn't be targeted or efficient. It'd be like shooting in the dark.
So, how do they gather this initial understanding then? What are these essential risk assessment procedures?
Well, it involves a multifaceted approach. First, getting that deep understanding of the entity and its environment, which includes its internal controls. That's key. Then it's about making extensive inquiries, performing preliminary analytical procedures. We'll talk more about those. And very importantly, fostering these crucial discussions among the entire audit engagement team. And sometimes, yeah, other targeted procedures might be needed too, depending on how complex the client is.
You mentioned inquiries. In a complex organization, I imagine different people might sometimes give conflicting information. How does an auditor sort through that beyond just, observing?
That's a really excellent point, and it highlights why inquiries aren't just with senior management. Auditors talk to the people responsible for financial reporting, sure, but also internal auditors if the company has them, even other internal groups like IT, marketing, or risk management people. They also reach out to external parties like legal counsel or valuation experts. What's fascinating here is how these different individuals at different levels provide varying, crucial perspectives. For instance, internal auditors often have unique insights into operational risks, things management might not focus on day to day. The key, though, is that these verbal inquiries are always corroborated, or sometimes even contradicted, by observations and actually inspecting documents. You can't just take someone's word for it.
Okay, speaking of looking at data, let's talk about analytical procedures during this early planning phase. This isn't just about crunching numbers, is it? It sounds more like they're looking for patterns or maybe red flags.
Exactly. It's much more than just number crunching. Analytical procedures involve evaluating financial data, yes, but also non-financial data by studying plausible relationships between them. Auditors might compare current financials to prior periods, or maybe to budgeted results, looking for significant deviations that don't make sense. They might look at changes in specific account balances or even consider non-financial stuff, like changes in the number of employees or square footage, and see how that correlates with, say, revenue. Does it track? And crucially, during planning, auditors are specifically required to perform analytical procedures related to revenue. This helps them spot any unusual or unexpected relationships that might indicate a material misstatement, including those potentially due to fraud. It's an early warning system.
Right. But beyond the data and the interviews, you mentioned one of the most powerful tools auditors have is their own collective brain power specifically, that engagement team discussion. Why is getting all these different perspectives together so vital?
Oh, this discussion is absolutely critical. It's essential for applying the financial reporting framework correctly and really thinking hard about the susceptibility of the financial statements to material misstatement. It's where professional skepticism truly comes alive, helping the team identify and assess those risks together. And importantly, it's not a one-time meeting. This discussion should be ongoing throughout the audit, adapting as conditions change or new information pops up. It emphasizes the need to rigorously investigate anything suspicious.
Okay, that makes sense. An audit isn't static, and neither are companies. So, how does the auditor adapt their understanding for really different entities, like, say, a tiny tech startup versus a huge multinational manufacturer?
That's where scalability comes in. Auditors have to tailor their approach. A small, less complex entity, for instance, might have pretty informal controls. Maybe the CEO or owner is directly involved in almost everything financial, and a strong company culture emphasizing integrity might be the main control. A larger, more complex entity, on the other hand, will rely on much more formal, extensive policies and procedures. Think documented processes, segregation of duties, layers of review. The auditor's professional judgment is absolutely key here in understanding these nuances, making an overall assessment of control risk, and then tailoring their audit approach to fit that specific client's unique structure. One size definitely does not fit all.
Beyond these procedures, what exactly does an auditor need to grasp about the nature of the entity itself? What specifics are they looking at?
They need a really deep understanding of its organizational structure, who owns it, and how it's governed. So how it's managed, who holds the shares, how decisions are made. They also assess the company's business model, basically. How does it make money and manage its costs? What are the core operations? And crucially, they evaluate the extent to which information technology, or IT, is integrated into everything. Because IT fundamentally impacts how transactions are handled and how the whole system of internal control is designed. For public companies, auditors even follow specific standards set by the PCAOB. That's the Public Company Accounting Oversight Board. These standards guide them to review public information, things like earnings, all transcripts, executive compensation deals, SEC filings, even trading activity in the company's stock, just to get a truly comprehensive picture.
Right. And when we talk about a company's objectives, strategies, and related business risks, this gets really deep, doesn't it? It sounds like understanding why misstatements might occur, almost like looking into the motivations of a character in our detective story.
It absolutely does. Business risks stem from circumstances that could stop a company from achieving its goals. And these often create incentives or pressures that, unfortunately, can lead to misstatements. For example, if management sets really inappropriate objectives, maybe unrealistic growth targets, or if they fail to adapt to major industry shifts, like a core product suddenly becoming obsolete, or maybe they face immense pressure to meet earnings forecasts. All of this can lead to bias in financial reporting. Think about a company introducing a brand new product. There might be pressure to underreport development costs to show early profitability. That's a risk. Or maybe rapid business expansion leads to piles of unsold inventory and potential write-downs they're reluctant to take. Even things like new accounting rules, tricky IT implementations, or major climate-related events disrupting supply chains. These can all directly impact financing and operations, creating significant new risks the auditor has to understand.
Okay, and how about the company's own accounting policies and its financial performance? How do auditors scrutinize those areas?
Well, auditors must evaluate if the accounting policies the company uses are appropriate for its specific business and consistent with the relevant financial reporting framework, like GAAP or IFRS. They pay special attention to complex areas where there isn't crystal clear guidance. Regarding financial performance, auditors examine what management themselves measures and reviews to run the company. What are their key performance indicators, or KPIs? Unusual growth or profitability, especially if it seems disconnected from what's happening in the industry or the company's underlying operations, can be a major indicator of management bias, particularly if that performance is closely tied to executive bonuses or stock options. And if we connect this to the bigger picture, the auditor's deep understanding of the industry, the regulations, the entity's nature, its objectives, business risks, and financial performance, all this information really aids in assessing inherent risk. Remember, inherent risk factors are characteristics that make an account or disclosure susceptible to misstatement before even considering any controls. Think about things like complexity, subjectivity, how much change is happening, uncertainty, and that potential for management bias we just discussed. The greater the complexity or subjectivity in an area, say valuing a complex financial instrument, the greater the need for the auditor to maintain a very high level of professional skepticism.
Makes sense. The world runs on technology now, and so do companies. How does the company's IT environment factor into the auditor's understanding? It must be huge.
Oh, it's huge. IT affects every single part of how transactions are initiated, recorded, processed, and ultimately reported. Every step. This, in turn, directly influences both the design and implementation of internal controls and the specific audit procedures auditors use to gather evidence. Auditors get a handle on this by touring facilities, asking detailed questions about the IT infrastructure layers, the hardware, the software, the networks, the operating systems, how data is stored. They need to thoroughly document this understanding because it directly shapes how they'll test things later on. You audit a company with a cutting-edge ERP system very differently than one still using spreadsheets for key functions.
Okay, let's zoom out even further then. What about external factors? What forces outside the company itself impact an audit, and why do auditors need to understand them?
Right. External factors are like the weather patterns affecting a ship's journey. Auditors need to know about them. These include things like industry factors. What's the competition like? What are the supply and demand dynamics? Regulatory factors. Are there new laws or tax changes coming? Also, government policy factors, things like government spending programs or changes in interest rates, which can really impact a company's bottom line. Then there are financial reporting framework factors, changes in accounting standards themselves, and rapidly evolving technology factors like industry-wide shifts to automation or new cybersecurity threats everyone's facing. And lastly, supply chain factors, which have become so critical lately, things like bottlenecks due to geopolitical issues or cybersecurity risks hitting suppliers. All of these can significantly impact a company's ability to operate and, therefore, its financial reporting.
So, what does this all boil down to? Auditors aren't economists, obviously, but they need a pretty solid foundational understanding of economic factors too, correct?
Absolutely. They need to grasp the economic environment because it directly influences things like a company's revenue forecasts, how they value inventory, sometimes even their ability to keep operating. For instance, understanding microeconomic principles like supply and demand helps them analyze sales trends or maybe question why inventory is building up. If demand for a key product is clearly falling across the industry, that impacts future revenue estimates and the value of inventory on hand. They also consider concepts like market equilibrium and elasticity. How sensitive are the company's sales to price changes or new competitors entering the market? And on the macro side, auditors look at business cycles, the natural ebb and flow of the economy. Is the economy expanding? Are we at a peak, heading into a contraction or trough? This context directly impacts a company's financial health and its future prospects. They also look at key economic indicators, things like leading indicators that try to predict future activity, like building permits or stock market trends, coincident indicators that move pretty much in sync with the economy, like industrial production, and lagging indicators that confirm trends after they've happened, such as the average duration of unemployment. Understanding these helps auditors assess the broader economic risks a company is facing.
All right, so with that really comprehensive map of the company's external and internal landscape now drawn, our audit detectives then turn their focus inward, right, to the crucial security system within the company itself, its internal controls. These sound like the unsung heroes of accurate financial reporting, but how exactly do auditors assess if they're, truly doing their job?
That's a perfect analogy. Internal controls, often structured around established frameworks like COSO, are relevant to the entire entity, not just one department. The auditor's focus isn't just on listing them out or categorizing them. It's about understanding how a specific control actually prevents or detects and corrects material misstatements in the financial statements. It's all about their effectiveness in practice.
Got it. But when it comes to controls, I imagine there are tons of them in any decent-sized company. How does an auditor know which ones are relevant to reliable financial reporting and actually worth spending time on?
That's a key question. Auditors focus their attention strategically. They look at controls that address significant risks of material misstatement. Really important stuff. They definitely focus on controls over crucial journal entries because that's where manipulation can easily happen. They look at controls they plan to test for operating effectiveness, meaning if this control works well, maybe we could do less detailed testing elsewhere. And then any others they deem appropriate based on their professional judgment. It's also crucial to distinguish between preventive controls, which aim to stop errors before they even happen.
Like hiring good people or having strong passwords.
Exactly. Competent staff, segregation of duties, firewalls, those are preventive. And then there are detective controls, which aim to find errors after they've already occurred.
Like bank reconciliations.
Precisely. Account reconciliations, performance reviews comparing actuals to budget, intrusion detection systems. What's fascinating here, and a key passkey insight, is that auditors don't need to understand or test all controls. They strategically use judgment to focus on the truly relevant ones that address the highest risks.
Makes sense. Now, how does the increasing use of information technology, IT, impact these internal controls? Are they still mostly manual, or has tech taken over?
Oh, IT affects all 5 components of internal control, fundamentally reshaping how they operate. It's everywhere. We still distinguish between manual controls performed by people. These can be good for complex, unusual transactions requiring judgment, but they're prone to human error and critically can be overridden by management. On the other hand, you have automated controls performed by IT systems. These are fantastic for high-volume recurring transactions. They're embedded right into the systems and can significantly enhance accuracy, timeliness, and security. And beyond that basic split, IT also involves specific types of controls. There are general IT controls, or GITCs. Think of these as the foundation for good IT broad policies, ensuring IT systems operate properly and maintain data integrity.
Like user access controls. Who can get into what system?
Exactly. Authentication, change management processes for software updates, data backup and recovery procedures, physical security for data centers, that's all GITCs. Then you have information processing controls, which apply to specific transaction processing within applications. Things like automated math checks, input validation edits, ensuring data is in the right format, stuff like that. They're built into the software doing the work.
Okay, let's dig a bit deeper. You hear about auditors doing a walkthrough. That sounds very hands-on. What exactly is a walkthrough, and why is it so important for understanding controls?
A walkthrough is exactly what it sounds like, in a way. It involves tracing a single transaction, maybe one sales order or one purchase invoice, right from its beginning, its inception, all the way through the company's systems until it ends up in the financial statements. The purpose is really threefold. First, to confirm the auditor's understanding of how key processes actually work. Second, to evaluate whether the design of the relevant controls seems effective. Could this control actually prevent or detect a misstatement? And third, maybe most importantly, to determine if those controls have actually been implemented. Do they exist in practice? Are people actually using them? It's much more than just asking questions. A walkthrough involves inquiry combined with direct observation, watching someone do it, maybe reperformance, the auditor tries doing it, and inspection of relevant documents, looking at the forms, the approvals. Inquiry alone is not sufficient because, well, what people say they do isn't always what actually happens.
Right, you need to see it action. So after meticulously understanding these controls through things like walkthroughs, what's the very next step for the audit team?
Okay, so after gaining that understanding, auditors absolutely must evaluate the design and implementation of those controls they've identified as relevant. This means asking two critical questions. First, are these controls, as designed, capable of effectively preventing or detecting and correcting material misstatements? And second, do they actually exist, and are they being used consistently by the company's personnel? Is the control actually in place? This evaluation is pivotal. It directly impacts the auditor's assessment of control risk for specific financial statement assertions. And that assessment, in turn, dictates the nature, timing, and extent of all the further audit procedures they need to perform the detailed testing.
And what about keeping track of all this? Audits generate a lot of paperwork or digital paper nowadays. How do auditors ensure they have proper documentation of their understanding of controls?
Documentation is critical. Auditors must document their understanding of the control environment and the design and implementation of relevant controls, especially those addressing significant risks of material misstatement. The pass key here is that this documentation can take many forms, basically. Anything the auditor can find or create to capture that understanding. This includes flowcharts. Those symbolic diagrams are great for visually mapping out processes and spotting potential control gaps or bottlenecks quickly. They might use internal control questionnaires, or ICQs, essentially checklists with yes-no questions, designed to pinpoint specific control strengths or weaknesses efficiently. Narratives are another option, written descriptions of the process flow. These are often better for simpler, less complex systems. For example, a narrative could just describe step-by-step how a customer sales order gets processed from receipt to being posted in accounts receivable. And finally, auditors often leverage documentation from the client itself, things like official procedure manuals, organizational charts, system descriptions. Whatever clearly documents the understanding is acceptable.
Okay, makes sense. Finally, on controls, it's important to remember, I guess, that even the best internal controls aren't completely foolproof, right? What are the inherent limitations that auditors always need to keep in mind?
That's a crucial point. Internal controls, no matter how well designed and operated, can only provide reasonable assurance, never absolute certainty, regarding the achievement of financial reporting objectives. This is because they are subject to several inherent limitations. There's always the risk of management override, where people in positions of authority deliberately bypass controls for improper purposes. There's plain human error. People make mistakes, misunderstand instructions, get tired. It happens. Collusion between two or more individuals can effectively defeat controls that rely on segregation of duties. If people conspire, they can often get around the system. Unexpected external events like a natural disaster or a major cyber attack can overwhelm even well-designed controls. And sometimes, the objectives management set for the controls might themselves be unsuitable for achieving reliable financial reporting. Auditors specifically consider and document the risk of management override in basically every audit because it represents such a fundamental vulnerability.
Okay, now we've journeyed through understanding the entity, its environment, and its controls. Now it's time for the real heart of the audit, the core of our detective story.
Yeah.
Gathering evidence. What actually counts as audit evidence, and maybe more importantly, what makes it persuasive enough for an auditor to actually stand behind their opinion?
Right, so audit evidence is essentially all the information the auditor uses as a basis for forming their opinion on the financial statements. This includes the company's underlying accounting records, things like the general ledger, subledgers, invoices, contracts, worksheets supporting calculations. But it also includes corroborating evidence obtained from other sources. This could be minutes from board meetings, confirmations received directly from third parties like banks or customers, information from analyst reports, or even the auditor's own physical observations or recalculations. And it's really important to note that increasingly some evidence might only exist in electronic form, especially in highly automated environments. The key is that the evidence collected must be both sufficient, meaning, is there enough of it, and appropriate, meaning, is it reliable and relevant to what the auditor is testing. The auditor uses professional judgment to decide what's sufficient and appropriate. The goal isn't absolute certainty, which is usually impossible or just too costly to achieve. Instead, it's about being persuaded by the weight of the evidence to form a reasonable professional opinion.
This brings us to a really crucial point. Not all evidence is created equal, is it? There seems to be a clear pecking order, a hierarchy, when it comes to how much weight auditors give to different types of information, almost like in a courtroom, right? Some testimony is just far more reliable than others. Can you walk us through this hierarchy?
Absolutely. There's a definite hierarchy, and understanding it is key. The passkey hierarchy for reliability, generally speaking, goes like this. From most reliable down to least. 1. Auditor's direct personal knowledge. This is top tier, the gold standard. It's evidence obtained directly by the auditor through physical observation, like counting inventory, inspection of assets, or recalculation, like checking depreciation expense. They saw it or did it themselves. 2. External evidence. This is evidence obtained directly from independent sources outside the client company. Think bank confirmations sent straight to the auditor, or accounts receivable confirmations received back directly from customers. Because it comes from an independent third party, it's considered highly reliable. 3. Internal evidence. This is evidence generated within the client company, like purchase orders approved internally, sales invoices, general ledgers, management reports. Its reliability is highly dependent on the strength of the company's internal controls. If controls are strong and effective, this evidence is more reliable. If controls are weak, its reliability drops significantly. 4. Oral evidence. This consists of responses to inquiries made of the client's management and employees. While necessary for understanding things, it's generally the least reliable form of evidence on its own, and should always be corroborated by other, more reliable forms of evidence. People's memories fade, or they might have biases.
That hierarchy makes a lot of sense. Now, let's pivot to some specific areas of engagement risk. These sound like complex areas that often require specialized attention from the auditor because they're not always black and white.
That's right. These areas often involve more judgment and specific procedures. One big one is compliance with laws and regulations. Management is ultimately responsible for making sure the company complies with all relevant laws and regs. The auditor's job is to provide reasonable assurance that the financial statements are free of material misstatement due to non-compliance with laws that have a direct effect on financial statement amounts, and to perform procedures regarding laws that don't have direct effect but where non-compliance could still have a material impact, like fines or penalties. But there are inherent limitations here. Management might deliberately conceal non-compliance, or determining legality can be complex and outside the auditor's expertise. Auditors try to identify potential non-compliance primarily by inquiring of management and those charged with governance, and by inspecting correspondence with regulatory authorities. For example, think about our HIPAA example earlier with healthy healthcare. While protecting patient privacy doesn't directly hit the balance sheet numbers, significant non-compliance could lead to massive fines, a contingent liability disclosure which the auditor absolutely must consider. Auditors also have specific reporting obligations if they do find non-compliant, which might involve reporting it up the chain within the company or in very specific, rare circumstances, even to regulatory authorities outside the company.
Okay, next up, accounting estimates. These are inherently uncertain numbers, aren't they? They're not like counting cash. So how do auditors deal with that built-in lack of precision?
You're absolutely right. Estimates like the allowance for doubtful accounts or provision for credit losses, warranty liabilities, or the fair value of certain assets like complex derivatives, they inherently lack precision. And because they involve judgment, they're highly susceptible to management bias, intentional or unintentional. The auditor's critical role here is to maintain a high degree of professional skepticism. They need to deeply understand management's process for developing the estimate, the methods they used, the key assumptions they made, and the underlying data supporting it all. Auditors look for indicators of possible management bias, things like consistently optimistic or pessimistic assumptions compared to prior years or industry trends, or maybe a pattern of estimates conveniently helping the company meet earnings targets. This raises an important question covered by a pass key. If an auditor concludes an estimate is unreasonable, the misstatement isn't just some vague difference. It's calculated as the difference between the amount recorded by management and the auditor's best estimate of the correct amount, or maybe the closest reasonable estimate within a range the auditor determines. For an allowance for doubtful accounts, for instance, auditors would review management's methods, like aging receivables, critically scrutinize their assumptions, like the historical loss percentages applied to different aging buckets, and verify the accuracy and completeness of the underlying data, the receivables trial balance.
Got it. Now, related party transactions, why are these especially tricky for auditors and why do they warrant such close scrutiny? They sound a bit suspicious just by name.
They're tricky, precisely because they are not conducted at arm's length. The terms of the transaction, the price, the conditions might be significantly different from what they would be if the deal was between two totally unrelated parties bargaining in their own best interests. This means the economic substance of the transaction might differ from its legal form, which requires special accounting treatment and, very importantly, extensive disclosure in the financial statements to ensure transparency for users. Auditors must work diligently to identify all related parties. This can include affiliates, principal owners, key management personnel, and their immediate family members. Then they need to understand the business purpose of the transactions and ensure they're properly accounted for and disclosed according to the reporting framework. These types of transactions also significantly increase fraud risk because of the potential for self-dealing or manipulation to benefit the related party at the company's expense. Key audit procedures include evaluating the company's own process for identifying, approving, and disclosing these transactions, and reviewing things like board minutes, conflict of interest statements, and SEC filings for clues. Remember that example of Doug owning 60% of ABC Company and selling it a building? If he sells it for $15 million when its fair market value is actually $40 million, the auditor needs to make sure it's recorded at the $15 million transaction price, yes, but also that the non-arm's length nature and maybe the difference in value are clearly disclosed. It highlights why valuation and transparency are so critical here.
Makes perfect sense. What about litigation claims and assessments or LCAs? How do auditors assess potential legal problems that could hit the company's financials down the line?
For potential legal issues, auditors need to obtain sufficient appropriate evidence about several things: the period in which the underlying cause occurred, the probability of an unfavorable outcome, and the estimated range of potential loss if one can be determined. The pass key here is that management is the primary source for identifying and evaluating contingent liabilities, things like pending lawsuits, warranty claims, or potential government investigations. They know what's going on legally. However, the auditor must corroborate this information obtained from management. A key tool for this is the letter of inquiry sent directly to the client's attorneys. In this letter, the auditor asks the company's external legal counsel to confirm management's assessments or provide their own views directly to the auditor. An attorney's refusal to respond properly to this inquiry, especially if they've devoted substantial attention to a significant matter, is considered a serious scope limitation for the audit. It could prevent the auditor from getting enough evidence and might lead to a qualified opinion or even a disclaimer of opinion.
Wow, okay. So that letter is pretty crucial. Finally, the big one for some companies. Go in. Concern. What does it mean if an auditor concludes there's substantial doubt about a company's ability to continue operating? That sounds like a really serious red flag.
It is indeed a very serious matter. Auditors have a specific responsibility to evaluate whether conditions or events, considered in aggregate, raise substantial doubt about the entity's ability to continue as a going concern for a reasonable period of time. That reasonable period is typically defined as 1 year beyond the date the financial statements are issued or available to be issued. There's a helpful mnemonic, FINE, to remember common factors that might indicate such doubt. F for financial difficulties, like recurring operating losses, negative cash flows, loan defaults. I for internal matters, like work stoppages, loss of key management, dependence on one project. N for negative trends, consistent losses, declining market share. And E for external matters, loss of a key customer or supplier, new legislation making a product obsolete, legal proceedings. If such conditions exist, auditors then must consider management's plans to mitigate this doubt. Do they plan to sell assets, borrow money, restructure debt, reduce spending, or issue stock? But critically, these plans need to be evaluated for both management's intent and, importantly, their ability to effectively implement them. Are the plans feasible? Likely to work? Depending on the auditor's final conclusion about whether substantial doubt remains after considering management's plans, there are significant implications for the auditor's report. This could range from just ensuring adequate disclosure in the footnotes to potentially adding an explanatory paragraph or a separate section under PCAOB standards explicitly discussing the substantial doubt.
Okay, let's unpack this next crucial point. An auditor can't possibly check every single transaction on a large company. That seems obvious, right? So how do they get comfortable with the whole picture, the overall fairness of the numbers, without looking at 100% of the items? That's where sampling comes in, I assume.
That's exactly right. It's usually just not practical or cost-effective to examine everything. So auditors use audit sampling. Audit sampling is defined as applying an audit procedure like vouching invoices or confirming receivables to less than 100% of the items within an account balance or class of transactions. The goal is to evaluate some characteristic of the entire group or population based on the results from that smaller sample. This is different from, say, testing all items if you have a very small population of high-value items, or just selecting specific items based on some criteria, like all transactions over a certain dollar amount. In those cases, you can't statistically project the results to the whole population. And inherent in sampling is, well, sampling risk. That's the possibility, the risk that the sample the auditor chose isn't truly representative of the entire population. This could lead the auditor to reach a different conclusion than they would have if they'd been able to examine every single item. There's a key passkey about sampling rules. Auditors generally assume the population they're sampling from is normally distributed for statistical validity. And crucially, the sample items must be selected using an unrestricted random method to avoid introducing bias. Things like random number generators or systematic selection with a random start are common. A large enough randomly selected sample will generally be representative, but it's super important to remember. While statistical sampling provides objective, quantitative measures of risk, it absolutely does not eliminate the need for professional judgment. The auditor still has to interpret the results and decide what they mean for the audit overall.
Okay, so what are the two big categories of audit sampling you hear about, and what are they typically used for?
The two main types serving different purposes are attribute sampling and variable sampling. Think of them this way. Attribute sampling is primarily used for tests of controls. It's basically looking for the presence or absence of a characteristic and attribute. It answers yes, no, or how often questions. For example, are invoices properly approved before payment? Or what percentage of timesheets have supervisor signatures? It's about the rate of deviation from a prescribed control procedure. Variable sampling, on the other hand, is primarily used for substantive testing, testing the dollar values of account balances. For example, estimating the total value of an accounts receivable balance or the amount of misstatement in an inventory count. It deals with quantities and dollar amounts. The passkey is to clearly differentiate. Attributes for controls, yes, no. Variables for dollar amounts.
Got it. Attributes, controls, variables equal dollars. Now, when it comes to sampling, auditors are always dealing with risk, as you said. What kind of mistakes can happen just due to the nature of sampling, and what are the implications for the audit if they occur?
Right. There are 4 critical types of sampling risk auditors worry about, 2 for each type of testing. Let's break them down. For substantive tests, testing dollar balances. 1, risk of incorrect acceptance. This is the big one for effectiveness. The sample results lead the auditor to conclude the account balance is not materially misstated when in fact it is. This is dangerous because the auditor might issue an inappropriate clean opinion. It impacts audit effectiveness. 2, risk of incorrect rejection. Here, the sample results lead the auditor to conclude the balance is materially misstated when actually it's fine. This isn't great because it leads to unnecessary additional audit work, making the audit less efficient. It impacts audit efficiency. Now, for tests of controls, testing controls are working. 3, risk of assessing control risk too low. Again, this affects effectiveness. The sample suggests the control is working effectively, so control risk is low, when in reality it's not effective enough. This might lead the auditor to reduce substantive testing inappropriately, potentially missing misstatements, impacts audit effectiveness. 4. Risk of assessing control risk too high.
The sample suggests the control is not effective, control risk is high, when actually it is working fine. This leads the auditor to do more substantive testing than needed. Impacts audit efficiency. So the passkey takeaway is crucial. The two effectiveness risks, incorrect acceptance and assessing control risk too low, mean the auditor failed to identify an existing problem, a potential misstatement, or control failure. The two efficiency risks, incorrect rejection and assessing control risk too high, mean the auditor falsely identified a problem where none existed, leading to wasted effort but ultimately likely still resulting in a correct opinion, just inefficiently. Auditors are generally more concerned about the effectiveness risks.
Okay, that distinction between effectiveness and efficiency risks is really helpful. Let's get practical then with attribute sampling. How do auditors actually use it to evaluate internal controls and decide, okay, can we rely on this control or not?
Right, so with attribute sampling for controls, auditors first determine the colorable deviation rate. This is the maximum rate of errors or deviations from the prescribed control procedure that they're willing to accept and still conclude the control is effective enough to rely on. Think of it as their error speed limit. They also estimate the expected deviation rate in the population, usually based on prior audits or a small pilot sample. Then they select and test their sample. Based on the number of deviations found in the sample, they calculate the upper deviation rate, sometimes called the achieved upper precision limit. This isn't just the raw error rate in the sample, it's the sample deviation rate plus an allowance for sampling risk, a statistical cushion. And the passkey here is critical. Auditors are conservative and always compare the upper deviation rate, the statistically adjusted worst-case scenario rate, to their preset tolerable deviation rate. So if that upper deviation rate is less than or equal to the tolerable rate, they can generally conclude the control is effective and rely on it as planned. But if the upper deviation rate exceeds the tolerable rate, they conclude the control isn't effective enough, they can't rely on it, and they'll need to increase their substantive testing for that area.
Okay, so they always look at that worst case rate. Moving on to variable sampling, how do auditors use samples to estimate actual dollar amounts rather than just counting errors like in attribute sampling?
Variable sampling is all about estimating monetary values. Before they start, auditors determine the tolerable misstatement for the account balance or transaction class they're testing. The passkey defines this as the application of performance materiality, which is less than overall materiality, to that specific sampling procedure. It's the maximum monetary misstatement they can accept in that population. There are a few common methods, like mean per unit estimation, ratio estimation, and difference estimation. The specifics get technical, but the basic idea is similar. For example, using mean per unit to estimate an account's receivable balance, an auditor would take a sample of customer accounts, audit each one to determine its correct balance, the audited value, calculate the average audited value for the sample items, and then multiply that average by the total number of items in the entire population. This gives them a point estimate of what the true total balance of accounts receivable likely is. They then compare this point estimate to the company's recorded book value. If the difference is less than the tolerable misstatement, they might conclude the balance is fairly stated. If it's larger, they've likely found a material misstatement.
Right. Sampling gives them a way to make an informed judgment without checking every single dollar. Now for what feels like a really exciting fundamental shift in auditing, audit data analytics, or ADAs. How is technology fundamentally transforming how auditors do their job here? This sounds like a game changer.
It absolutely is a game changer. ADAs refer to using data analytic techniques, software tools, and specific methods to analyze vast amounts of financial and non-financial data. The goal is to discover patterns, identify anomalies, extract useful information, and find relationships that traditional sampling methods often just couldn't uncover because they only looked at a small slice of the data. The benefits are really immense. Auditors gain a much deeper, data-driven understanding of their clients and their business processes. It allows for advanced risk assessment, potentially highlighting risks in areas they wouldn't have even thought to look before. Probably the biggest benefit is expanded audit coverage. Instead of just sampling, ADAs often allow auditors to test entire populations of transactions 100% coverage. This dramatically increases assurance. Plus, it significantly enhances fraud detection capabilities by spotting unusual patterns or outliers much more easily. And often it leads to increased audit efficiency too, by automating tasks that used to be manual, It's not just faster, it's smarter auditing.
Okay, that sounds incredibly powerful. How do auditors actually do ADAs then? What are the typical steps, and what kind of tools are in their digital toolkit for this?
There's generally a structured approach, often involving 5 key steps. First, they plan the ADA. What's the audit objective? What specific procedure are we performing? What data do we need? Second, they access and prepare the data. This often involves getting data extracts from various client systems and then cleaning, transforming, and validating the data to make sure it's usable and reliable. This ETL extract, transform, load part can be challenging, but it's crucial. Third, they consider the relevance and reliability of the data they've obtained. Is this the right data? Is it complete and accurate? Fourth, they actually perform the EDA using selected software tools and analytical techniques. And finally, fifth, they evaluate and address the results. What did the ADA find? Are there anomalies or potential misstatements? What further procedures are needed? As for tools, auditors use a range. There are specialized data extraction and preparation tools, like ETL software. There are sophisticated data modeling and analysis tools capable of running complex analytics, like regression analysis or maybe Benford's law testing for fraud.
And critically, there's data visualization software tools like Tableau or Power BI that create charts, graphs, and dashboards to help auditors interpret the results and communicate findings effectively.
This is where it gets really interesting, I think. ADAs aren't just one single thing. You're saying there are a whole spectrum of techniques that can answer very different kinds of questions depending on what the auditor needs to find out.
Exactly right. We can broadly categorize ADA techniques into 4 types, each answering a different fundamental question. 1. Descriptive analytics. These answer what happened or what is happening now. They summarize data to provide insights, think summary statistics, mean median mode, sorting data, aging analysis like for receivables, or maybe sequence checks. For example, an auditor at Tartar Eatery Corp might use filtering a descriptive technique to look at all sales transactions recorded on Sundays, knowing the restaurants are closed then. Finding transactions would immediately flag potential errors or fraud. 2. Diagnostic analytics. These dig deeper to answer why did something happen. They look for correlations and root causes. Techniques include clustering, grouping similar items, drill-down analysis going from summary to detail, variance analysis, or maybe data mining to find hidden patterns. For instance, reviewing Moroni Publishing's financials, an ADA might show a significant drop in the current ratio, a diagnostic alert. The auditor could then drill down into the underlying transactions to find that a large, unusual short-term note repayment was the primary cause, explaining the why. 3. Predictive analytics. These aim to answer what is likely to happen in the future. They use historical data to forecast future outcomes or assess risks. Techniques include regression analysis, modeling relationships, forecasting based on trends, time series modeling, or even sentiment analysis of text data. For example, an auditor for SGT retailers might analyze social media sentiment about a specific product. If sentiment turns very negative near year-end, but reported returns for that product remain unusually low until after year-end, that could predict a risk of unrecorded returns or channel stuffing potential misstatement or fraud. 4. Prescriptive analytics. These go a step further to answer how can we make something happen or what should be done. They use analytics to recommend actions or optimize processes. Techniques include what-if analysis, machine learning algorithms, or natural language processing, NLP. For example, at Parkle auditors might use optical character recognition, OCR, to scan paper invoices in NLP to automatically match key invoice details, vendor name, amount, date, against electronic payment listings. This prescriptive ADA can automate the 3-way match process and flag discrepancies for investigation much faster than manual checking.
Wow, it's amazing to see how these different types of techniques can be applied throughout the entire audit process, not just in one specific part.
They really are becoming pervasive. In risk assessment, ADAs can identify risks auditors might not have spotted otherwise, like analyzing Costanza Retail's sales data, maybe plotting sales by quarter across different store locations on a chart. An unusual spike or dip at one location compared to others might highlight a specific risk needing investigation. For tests of controls, ADAs can test controls more efficiently and effectively. For instance, using a fuzzy logic ADA at Tillman Financial to check if system access was consistently revoked for all discharged employees within, say, 24 hours, testing the effectiveness of that critical IT control across the entire population of leavers. And in substantive procedures, ADAs can provide direct evidence about account balances. Like at Heenan Auto, an auditor might build a regression model using ADA to predict warranty expense based on historical relationships with factors like units sold and repair costs. Comparing the ADA's prediction to the company's recorded expense can provide strong evidence about its reasonableness or highlight potential misstatements.
Okay, but for any of these powerful ADAs to be effective, the underlying data they're analyzing has to be good, reliable data, right? Garbage in, garbage out, as
Yeah.
I say. How do auditors make sure the data they're working with is actually reliable?
That is absolutely critical. Data sourcing and ensuring reliability is a huge part of using ADAs effectively. Auditors need to understand where the data comes from, typically various information systems like the company's ERP, Enterprise Resource Planning System, CRM, Customer Relationship Management System, maybe specialized manufacturing or inventory systems. Data might also come from data storage functions like data lakes or data warehouses. They also need to understand the nature of the data. Is it structured data, highly organized, easily searchable, typically found in databases and relational tables? Or is it unstructured data, things like emails, social media posts, videos, PDF documents, which is much harder to analyze systematically but can contain valuable insights? Auditors often have to perform normalization procedures on structured data, like breaking down large tables into smaller linked tables to reduce redundancy and improve data integrity, like separating student info from course info in a college database example. Then, to ensure reliability, auditors perform various procedures. This might involve testing the client's general IT controls, GITCs, over the systems generating the data. They might perform reconciliation of the data back to the general ledger. They might use the ADA itself to perform analytical procedures on the data to check for internal consistency. Or sometimes, especially if data is processed by a third-party service organization, they might need to obtain and review a SOC1 report on that organization's controls. For instance, when auditing Reagan Phillips Financial's complex equity accounts, auditors would perform reconciliations, maybe use ADAs to analyze debt-to-equity ratios over time, or even run classification analytics to assess bankruptcy risk. But all of this relies on first establishing that the underlying equity transaction data is reliable through GITC testing and other procedures.
Okay, makes total sense. Finally, after all that sophisticated analysis, it comes down to interpreting the results, often presented in visualizations like charts and graphs or reports generated by the ADAs. How do auditors make sure they're seeing the full, unbiased picture from these outputs and not being accidentally misled by a fancy chart?
That's a crucial final step, evaluating the output properly. The results of an ADA, especially any visualizations, must be clear, understandable, and directly linked back to the specific audit objective. Auditors need to be skilled at creating and interpreting effective data visualizations. Key tips include choosing the right chart type for the data and the message. Bar chart, line chart, scatter plot, etc. Using correct scaling is vital, for instance. The y-axis on a bar chart should almost always start at 0 to avoid exaggerating differences or creating a misleading impression. Using appropriate colors and clear labeling is also important. And critically, the visualization needs to focus squarely on the audit objective to avoid introducing bias. A poorly designed chart could inadvertently highlight insignificant differences or obscure important patterns. Different visualizations help interpret different ADA results, like regression scatter plots showing relationships, variance bullet charts comparing actual to budget, period-over-period bar charts showing trends, classification charts grouping items, or trend line charts forecasting outcomes. They help auditors quickly grasp the results and identify areas needing further investigation. Finally, any potential misstatements or significant anomalies identified by the ADAs need to be carefully evaluated. Auditors typically group them into findings that are clearly inconsequential. These are documented, but usually no further work is needed, or those that are not clearly inconsequential, which do require the auditor to perform further, more detailed audit procedures to understand the nature and cause and determine if there's a material misstatement.
Wow. What an incredible journey we've been on. From those broad strokes of understanding a company's entire environment and the subtle, critical nuances of its internal controls, all the way to the statistical precision of sampling and the truly game-changing power of audit data analytics. We've really seen how auditors meticulously put together this comprehensive picture of a company's financial health.
It really is about so much more than just finding errors, isn't it? It's about providing assurance, yes, but also deeply understanding the underlying business realities and using critical thinking, professional judgment, and now these powerful tools to connect all the dots. The ultimate goal, as always in our deep dives, is to provide you, the listener, with that well-informed shortcut, distilling these complex processes down into actionable insights and a better understanding.
So, what does this all mean for you listening? Well, next time you look at a company's published financial report, maybe take a moment to consider all those layers of inquiry, analysis, judgment, and now these cutting-edge technological tools that likely went into assuring its accuracy. What questions might you ask yourself, looking deeper than just the surface numbers, now that you have a better sense of the complex detective work that goes on behind the scenes? Something to think about.